Today, we're going to be looking at something in public sector, a 20 marks area that is going to be crucial, which is evaluation of financial statements, and provide you with some blueprint on the various principles that you need to understand when it comes to evaluation of financial statement. As I say always, it is important you understand the structure of the syllabus, the structure of the examination, then you understand the principles underlining each of the topics, and then you expose yourself to questions, and most importantly, you then work on your speed and accuracy, and definitely you can go into the exam hall so you can write the exam and pass the examination. And that is exactly what we are doing in this series to help you to go through. Last week, we focused on financial reporting, looking at some few issues in the accounting standards. Today, we are looking at public sector, a 20 marks area, evaluation of financial statements. That will be crucial for you in order for you to pass the examination. So let me bring up my screen real quick and let's get into. So as we get ourselves into the discussion, the first thing I want to do is to provide you with the examination structure so you have an idea about what to expect in the exam hall, because it is important you know what the examiner is going to be doing and bringing in the exam hall, so that will help you to know how you can study and how you can put yourself in the position to pass the examination. And so in the exam hall, 100 marks as always, 5 questions that we're going to be having. What are the issues that we need to be mindful of? Number 1, there is going to be question on financial statement preparation in the public sector. Okay, so financial statements preparation. Now, it depends. The examiner can come for you in respect of a covered entity, meaning a ministry, a department, an agency, a metropolitan, municipal, or a district assembly, or other covered entities. It could be a state, a public school, a public hospital. It could be a public entity that is reporting under the IPSAS, whatever. So it could be a covered entity, or it could be on the consolidated fund, which means that you are dealing with a central government. All right. So on the consolidated fund, which means you are dealing with the central government. But financial statement preparation is going to be there. Now, what are the types of financial statements we are going to be interested in? The statement of financial performance, the statement of financial position, the statement of changes in the net assets, and then the cash flow statement. The examiner can come from any of these, and you have to be in the position to be able to understand them so you can put yourself in the position to pass the examination. In addition to that, the second issue we need to know about is what we are going to be going through in a few moments, and that is evaluation of financial statements. There's a 20 marks area waiting for us in the exam hall as well that we need to understand. So how do we evaluate financial statements? There are 3 methods available that the examiner can bring. One of them, so we have common size analysis, where you are changing the financial statement into percentages. We have ratio analysis, where you are calculating various ratios and interpreting the ratios. Then we have the budget variance analysis, where you are preparing a statement of budget performance. So these are the 3 things. One of them will be in the exam hall for 20 marks for you to do the preparation or do the calculation and then interpret as well. So 20 marks area, evaluation of financial statement, you need to understand that very well. Then the examiner is also going to be getting excited to bring some questions on IPSAS. That is the International Public Sector Accounting Standards. And so in the exam hall, we are going to be seeing some questions coming in from the International Public Sector Accounting Standards. 20 marks done deal waiting for us in the exam hall in order for us to pass the examination. But just so you know, in addition to the 20 marks on the IPSAS, that is the International Public Sector Accounting Standards, that we are going to be seeing as a dedicated question in the exam hall, in order for us to even deal with the financial statement preparation, we need to also understand the IPSAS. And so there are some IPSAS that, whether you like it or not, as a public sector accounting and finance student, you must know about them. And that is IPSAS 17, Property, Plant and Equipment, IPSAS 12, Inventory. All right, you must know about this. It's not like something you need to negotiate. It's a done deal, and you must know about them because they are going to be there in the exam hall. Then there are some other IPSAs that we can talk about, like maybe IPSAS 3, IPSAS 5, borrowing cost, and others. But we'll get into some of these things later. But that's the third key area that we need to be mindful of. Then we're going to be having 20-mark question also on PIFA and budgeting. Okay, so PIFA and budgeting is also another 20 marks area, 10 marks for each. And so that is why you have to be careful. There is a lot of material under public sector budgeting, a lot of material to go through in public sector budgeting. And the marks is 10 marks. And so you need to make sure you know how to structure yourself out, the key issues in budgeting that you have to focus on in order to increase your chances of passing the examination. But public sector budgeting is going to be there. Then the PIFA, the Public Expenditure and Financial Accountability Framework, that is also going to be there for us. Done deal in the exam hall. Now, the examiner has a couple of choices that he can, go with when it comes to the PIFA idea. He can bring a calculation PIFA where we are using the weakest link method or the average method to evaluate the efficiency and effectiveness of the public financial management system of the government, or we are going to be asked to prepare the statement of budget performance in the PIFA environment, and the scores are going to be provided, and after the preparation, we are going to be interpreting that and suggesting or making recommendation on how the improvements can be made by the entity, or if you want, the government in question. So PIFA is going to be there. Then certainly the 7 pillars, we need to understand that as well. Then the critical performance dimensions, there are 6 critical performance dimensions of an open and orderly public financial management system. You must understand that as well. So that is 20 marks as well coming for us in the exam hall. So 20 on financial statement preparation, 20 on evaluation of financial statement, 20 on the IPSAS, International Public Sector Accounting Standards, 20 on PIFA and budgeting, 10 marks each. And then the last area is going to be governance in the public sector. Governance in the public sector. And then also the issue in respect of the regulatory framework. Okay? Governance in the public sector and the issues in respect of regulatory framework. Now, that 5th area there, now that doesn't mean this is how the questions will be arranged. Okay, let me tell you that up front. It doesn't mean the question will be arranged this way. The arrangement of the question can change, but these are the 5 questions we're going to be having in the exam hall. Now, governance in public sector and the regulatory framework, these are the introductory issues that you go through when you are doing public sector accounting and finance, like accounting bases, accounting approaches or techniques, talking about issues in respect of users of public sector financial statement, talking about issues in respect of the role of key public officers and institutions, various things, those introductory issues, and then certainly dealing with the Nolan 7 principles for public sector officers. So these are the key issues we need to understand, and that is your public sector syllabus and examination. And so if you are going to go into that examination for the public sector, then you should be strong in these areas and make sure that you understand each of the things here, and also expose yourself to questions under pressure so you can go into the exam hall and pass the examination. So these are the 5 areas that we must understand. Now, I want to quickly also share some thoughts with you on the Chief Examiner's report for the March 2025 examination, and some of the things that the Chief Examiner spoke about. You see, one of the smartest things you can do, and one of the key things in life, is to observe what people have done and learn some lessons from there so you can avoid those mistakes going into the future, and that makes you to become successful as quickly as possible. And so I want to share with you some few things that the Chief Examiner highlighted as to the reason why many students failed the March 2025 examination, and by extension, challenge for students sitting for the examination in general, and so that you can see that and use that as fuel and know what to avoid, how to navigate yourself, and put yourself in the position to pass the examination. So this is March 2025 ICAG question, and you can download it on the ICAG website. You don't have to buy any ICAG past questions. It's available for free download. So let's look at some general weaknesses from the horse's own mouth, that is the chief examiner. What does the chief examiner say in respect of students' weaknesses? The first one is lack of understanding of the requirement of the questions. Lack of understanding of the requirement of the question. One of the things in public sector is that you can easily digress. Easily. Because sometimes the examiner will ask you to do one thing, before you know it, you are doing another thing. Because it looks like the things are the same, but they are different. For instance, if I asked you, or if there's a question that says we should prepare the statement of budget performance, all right? And the purpose of the preparation of the statement of budget performance is to assess budget reliability of the entity, which is the first pillar in the PIFA framework. That means, although you are required to prepare the statement of budget performance, you are preparing that in the PIFA environment. Now, there is the traditional statement of budget performance where you bring your original budget, then you get your revised budget, then you get your actual results, all right? Then you get your out 10 in percentages, then you can get, or maybe out 10 in currency terms, then you can get an out 10 in percentages. This is a standard statement of budget performance pro forma. And the way you get a revised budget is the original budget given to you plus any supplementary estimate. Plus any supplementary estimate. Because if you're a good student from the public sector class and you have done budgeting also, you know that the Constitution requires that at least by 31st July within the year, the Minister of Finance must go to Parliament and report to Parliament the results from the last quarter of the previous year and then the first half of the current year. And that is the mid-year review. At that mid-year review, the government can request for additional funding or some changes. Now, that additional funding they are requesting for is the supplementary estimate. So when we add that to the original budget, which was submitted before the end of the year, which was approved, it gives us the revised budget. So in the preparation of the statement of budget performance, we are now going to be comparing the revised budget with the actual, and that gives us the out 10. And in a way, we are assessing budget reliability, and that is budget variance analysis, BVA. We are preparing the statement of budget performance, and that is budget variance analysis. However, in PIFA, the examiner can ask us to analyze budget reliability using the statement of budget performance. In that case, the slide is going to be different. And so still, we may have our original budget. Yes, we may have the revised results. Yes, we may have the actual results coming up. Revised budget. Okay. Yes, we may have out 10, which is in percentages, but the last column will be score. Because this is the PIFA environment. Because the examiner will then give you what the out 10 percentage represents, whether it is A, B, or C. And so if you are not careful, and you are supposed to prepare the statement of budget performance in the PIFA environment by indicating the score, and you ignore that and you go and prepare the normal statement of budget performance and the budget variance analysis, that is total digression. And that is one of the key challenges that the examiner raised concern on, that many students lack understanding of the requirement of the questions. And sometimes there are a lot of things in public sector that are similar. They look alike, but there is a distinction between them. And so you must understand the context of the requirement and know how or what you are being asked to do by the examiner. That's the first thing. Number 2 is limited coverage of the syllabus. Many people don't know even that this is the structure of the syllabus. And so many are not able to cover the syllabus. And the reason many people are not able to cover the syllabus is another issue that the examiner raised concern on: ill preparation. Ill preparation. As we speak right now, there are some of you have not really started studying for some reason. We are in week 9, but you have not really started studying. And you've been postponing, pushing it, but you've registered for the exam, or the exam registration will be closing on the 12th of June, 2025 for the July examination. You are preparing to register, but you have not been studying. And you are there waiting to take 1 week miserable leave from your company, cause financial loss to the company or the state, and you think you can use that 1 week to go through everything in the syllabus and go into the exam and pass the examination. Some of you also think that, you can attend some magical class somewhere, and within 6 hours, your brain is going to be open literally, and the book is going to be dropped into your brain, and magically you will understand everything in the syllabus and go into the exam hall and write the examination. It is not going to work. We have 5 more weeks to go. If we include today, 5 more weeks to go. If you are serious about passing the examination, you don't have to go fail the exam. You have to start studying and be serious about yourself. Be serious about what you're doing. Because this is the chief examiner's report saying that people are limited on the syllabus coverage. People are ill prepared for the examination, and hence they couldn't get the marks that they are supposed to get. Because sometimes people get 5%, 15%, and you ask, what the heck did you go and do in the exam hall? And there is this myth that, public sector, Charlie, just reading. No. The ICA examination now and the public sector examination now, if you come in with that old school mindset, you will go and fail, and you write the paper over and over again, and you keep failing. So if you want to pass the examination, then you must be adequately prepared for the exam. Don't be ill prepared. Some of you have not started learning yet, but you want to write the exam. You have registered to write the exam. What are you going to write? And you are preparing to attend one magical class somewhere, and you think that is going to do miracles. No, it's not going to do anything. You can pray, you can drink anointing oil, you can fast, you can do whatever the heck you want to do. If there is nothing in your brain, you're going to go fail the exam miserably. And this is the observation of the chief examiner, that students are ill prepared and students are not able to cover the syllabus. Yes, it appears to be simple here. If you look at the structure, financial statement preparation, evaluation of financial statements, the IPSAS, PIFA and budgeting, governance in public sector, and then budgeting. Regulatory framework. Yeah, it appears simple. But it is not that simple, my friends. It is not that simple. And that is why, if you're a follower of my work, I keep on saying this over and over again. Don't wait 2 weeks, a week to the exam, and take some miserable leave from your workplace and think you can magically do things. It doesn't work that way. Break down the process. Because that is how you can prepare to pass the examination. And certainly the last thing that the chief examiner raised concern on was poor time management. Now, this is happening in the exam hall. People are not able to work with speed and accuracy. There are times people don't even know how to punch figures on their calculator. Sometimes handwriting, because you normally don't write because you are always behind the PC or something like that. Now you're supposed to write as fast as possible under examination pressure. How do you handle that? And that is why you don't have to wait. That is why there is no miracle class anywhere that you have to attend. Because you cannot finish this in any 6-hour class. You cannot do this magically anywhere. You must understand everything in the syllabus. In addition to that, you must practice questions. You must work with speed and accuracy. You must work on your emotions. You must work on familiarizing yourself with how to even punch on the calculator with speed and accuracy. Because I say this all the time, that some of you fail the exam, or you are going to fail the exam, not because you don't know, but it's because you can't even work with speed and accuracy. By the time you realize, they say get ready to stop work and you have answered only 2 questions. Get ready to stop work and you've answered only 3 questions. Then you start panicking. There you know you have failed the examination. And many of you know that the exam you are going to write, you will fail. Many of you know that the exam that you are going to write, you will pass. You know. You know because you are not studying. You know because of the efforts that you are putting in. And that is something you need to understand. I will not come here and tell you, oh, small, it go be. It no go be. The ICA questions are not set for people to just walk around and walk into the exam hall and pass the examination. No. The exam is according to international professional examination standards. So you cannot just do some shabo. This is not the 2013 ICAs, the 2010 ICAs. No, the ICA we have now is La Creme de la Creme ICA. You have to be intelligent. You have to have an understanding of the syllabus. You must be familiar with the structure of the exam. You must understand the principles. You must know how to write out your answers. You must work with speed and accuracy. You must control your emotions psychologically in the exam hall. You must be able to know how you can write better. You must know how to present your work. All of these things, you cannot do them in a 6-hour class anywhere or in a 3 days to the exam anywhere. It is not going to happen. You know it doesn't work. But for some reason, you are still lying to yourself and you keep going on this path. But that is what you must understand. There is no shortcut to the ICA examination. There is no shortcut for passing the exam. There is only one way to go. Understand the syllabus. Understand the principles. Know the things that makes people fail the exam, and put yourself in the position to go into the exam hall, write the exam with confidence, and pass the examination. And that is what I will tell you. I know you are busy. I know you have a lot of things at your disposal. But you know something? Nobody cares. Nobody cares how busy you are. Nobody cares how many babies you have to take care of, what your boss is taking you through. Nobody cares. That is the reality of the exam. ICA examination board doesn't sit there and say, oh, by the way, our students, they are busy executives. So let's set the question in such a way that, no. So nobody cares. You must create the time and make the necessary sacrifices to study and pass. But if you think you can sit down 3 days to the exam, a week to the exam, and do some magic, congratulations. You will get to the exam hall. There is an air condition there, but you'll be sweating like a pregnant fish. And after that, you will be decimated. You will be ashamed of yourself. You will walk out of the exam hall ashamed and disgraced of yourself. Your results will come and you will fail. Why? Because you did not study. It is not about the exam. It is about you. So these are the things that a chief examiner raised concern on that you must understand and know about. So if you can Be adequately prepared for the exam. If you can work on your speed and accuracy so you can manage your time properly, if you can cover the syllabus well, 95%, 98% of the syllabus is okay, then you can understand the context of the question and how various treatments are supposed to be done. That is the only way you can go into the exam hall and pass the examination. And that is what you must understand about the Chief Examiner's report and the Chief Examiner's concern for the March 2025 examination. And as I said, these things actually cut across almost all the subjects. It cut across almost all the subjects. So if you are preparing to sit for the exam, please don't wait 3 days before you come. Don't wait 2 days before you start studying. Start learning now. If not, you're going to go fail the exam. And it is nobody's fault. It is your fault. So, having done that, let's go to the discussion for the day, because I want to, as mentioned, focus on evaluation of financial statements. I want to just give you something on that today, evaluation of financial statements. And then we can get excited to solve some questions so you see how it all adds together. So, evaluation of financial statements, 20 marks in the exam hall. Now, this is like, financial statement evaluation in the private sector ratio analysis, right? But it's a little bit different because we have various indicators, quite different, in addition to sometimes what you do in the public, in the FR class or CR class, because we are in the public sector, right? So how do we evaluate the performance of an entity, a covered entity, or the central government? How do we evaluate their performance, financial performance and position? There are 3 methods that we must know about, 3 methods. One of them will be in the exam hall. One of them will be in the exam hall. The first one is by the preparation of the common size statement. Okay, so we could be asked to prepare the common size statement. Now, the common size statement is all about changing the financial statement into percentages. I'm going to be illustrating that to you as we proceed. The second one is the ratio analysis that we want to get excited into today. And then the third one is what I mentioned to you earlier, the budget variance analysis, which is where you are preparing the statement of budget performance. So one of these 3 will be in the exam hall. Now, don't try to be smart and try to do any ratio and proportion that, November 2024, this one came, March 2025, this one came, so in July 2025, this will come, and then in November 2025, because there are various perspectives of questions under ratio analysis. There are various perspectives of questions under common size statement. There are various perspectives of questions under the budget variance analysis or the statement of budget performance preparation. And so you must understand all 3, know how to prepare them, work through them, and know how to interpret them generally. And we're going to be getting into this as we continue in the discussion. So these are the 3 methods or approaches that can be used to evaluate the financial performance and position of a covered entity or the central government or 2 different countries' performance at the end of the day. So let's go in and look at some few things here. And I'm going to be coming in from the March 2025 because I want us to just use the question that was there as a guinea pig for our discussion. That's question number 4. Yeah, question number 4. So you can see here for 20 marks, A aspect of the question said, prepare a paper for presentation at an upcoming PFM forum to evaluate the performance of the 2 countries using the following metrics. Now, I will come to the interpretation part, which is the B part. It says, interpret the performance. I'll come there, give you some guidelines in respect of what you're supposed to do there. So stay with me carefully. And as you can see, it's 20 marks. The calculation is taking 12. The analysis part is taking 8, giving you 20, which was what I told you exactly, because that is how the examiner is going to be dancing when it comes to evaluation of financial statements. So let's go back up there and see the preamble of the question. Below are EPSA's compliance financial statement of two developing countries, Boga and Obimanso. So two different countries. The reason why that is important is because that will influence your choice of basis for the analysis write-up. And I'll come back to this in a moment. Just stay with me. For the year ended 31st December 2023, expressed in the local currency of Ghana and published by an international public financial management organization domiciled in Accra, Ghana. Okay, so we see the financials. This is the statement of financial performance there. The same as statement of revenue and expenditure. We see the statement of financial position also there in that case. Now let's go to the requirement and see what we are calculating. The first thing we are calculating is for us to work for revenue to total assets. Now, if you're a good student from the financial reporting class, you can relate this as the asset turnover ratio, which is measuring the utilization of the entity's assets in the generation of revenue. So in your financial reporting class, sales divided by capital employed or sales divided by net asset or sales divided by total asset tells you about the efficient utilization of assets in revenue generation. When we come to the public sector, revenue to total assets is the same concept. How are the countries using the assets available at their disposal in generation of their revenue? Now, the reason I am drawing that parallel for you is because when you understand it, that there is a relationship like that, it helps you to appreciate, then you can just contextualize for public sector accounting. And so that is why I always say that you have to do public sector and financial reporting together, because of the correlation and the connection that exists between them, with the little contextualization when we are in the public sector and when we are in the private sector. So total revenue to total assets. So let's see what we got. Boga and then Obimanso. I'm going to, whatever the heck, probably put my formula here. And then I'm going to put the workflow here. Boga and Obimanso, like this. So revenue to total asset is total revenue divided by total asset. Now here the answer is going to be looked at in times, generally in that particular case. So it's just going to be in times. So let me go in, just copy this and bring it up. Now you don't have to present like this. I'm just choosing to present like this because I want to keep my work a little bit cleaner. So what is the total revenue for each country respectively? You want to be mindful of the figures that you're picking. This is our total revenue respectively. 363,240. 363,240. Obimanso is 399,285. Okay. So we divide that by their total asset. To get a total asset, you go to the statement of financial position, and you can see total assets here, respectively. That is 238,800. And we divide that by 295,450. So we punch it out respectively. What do we have? Getting 1.52 here. It depends. You can decide to work to one decimal place or two decimal places to keep it simple for yourself. And I'm getting 1.35 here in that case. What does that mean in principle? It means that country Boga is able to, from the face value, it means that, the asset turnover is bigger. So they are able to use the asset to generate revenue to support their policies than Obimanso. But you got to be careful because there are a couple of things that you have to also pay attention to. As you can see the total assets, you realize that Boga has a lower total asset than Obimanso. And when a total asset is lower, sometimes that could be an indication. So if you, and this is where the interpretation comes in. This is where the interpretation comes in. And I need you to pay attention here, because this is where many can fall. All right? Because some can reliably do the calculation, but the interpretation sometimes become a problem. Now, so if you look at this, you would then say that, oh, Burger Limited is efficiently utilizing its assets in generating revenue than Obi Manso Limited. But on absolute terms, you realize that Obi Manso has more revenue than Burger Limited. Okay? So, because if you look at the absolute figures, Obi Manso has more revenue than Burger Limited. But Burger Limited revenue to total asset is greater, marginally greater than Obi Manso Limited. So what is the issue? What could be the reason for that? What it could mean sometimes generally is that two things. Number one, either Burger Limited, although they have a lower capital employed, they are efficiently utilizing their asset to generate more revenue, okay, proportion-wise, as compared to Obi Manso. Do you get the idea? Or the fact that the Obi Manso Limited has a higher capital employed, hence you expect that they will have a lower asset turnover in that particular case. And this is the limitation about using ratios to analyze two different countries. That's the limitation part, and we'll come back to that in a moment. But that is the idea about revenue to total assets. How efficiently are the countries using their assets to generate revenue? That is like asset turnover in your financial reporting class. And we expect this ratio to be higher, just that you got to be careful, as I mentioned. Second one is the current ratio. You don't need a miracle on current ratio, do you? You don't need a miracle on current ratio. So current ratio is your current asset divided by current liabilities. So in a simple language, this is just measuring the ability of each country to be able to pay their short-term debt as they fall due. Now, with current ratio, usually we expect that it should be above 2. Okay? Any current ratio that is below 2, we could consider the entity to be having some problems. For quick ratio, it should be above 1. So current ratio above 2 is good. Quick ratio above 1 is good. And that is the idea there. So let's come to the calculation. So current ratio, and that is going to be their current assets. So here we're going to stay in the statement of financial position. And as you can see, respectively, current asset is here, 96,078,850. So we divide that by the current liabilities, respectively. You can see current liabilities for them here, because this is current liabilities. So 94,800, 97,850. So how many times can it cover? 96,000 divided by 94,800. That's 1.01 is to 1. That's not too good. And these people are maybe 8.1, 0.81 is to 1. So you realize that, yes, country Burger, yeah, in a way, it's just 1. Technically, it's just marginally above 1. It means that's not a good point, a place to be. But Obi Manso is even worse, because their current ratio is less than 1. It tells you that both countries may be facing liquidity issues. Next, debt to owner's fund. This is quite an amazing ratio that the examiner asks students to calculate. Debt to owner's fund. Now, typically, we don't have owner's fund in public sector, because debt, this is like GRE ratio in the private sector. This is like debt to equity, right? But in the public sector, we don't have debt to owner's fund, because we don't have owner's fund here. And so there are two ways we could approach this in the public sector. It could be the gross debt that is interest-bearing debt, got to be specific on that, divided by the net asset in that case. That's one way to go about it. Or we could calculate that as gross debt divided by total assets. So we can go with either of them in the presentation if we want to. So debt to owners fund. If we are going with the second approach, gross debt to total assets, let's go pick gross debt. Now that is under non-current liability, right? Gross debt, interest-bearing debt. But you have to be careful because sometimes there could be some interest-bearing debt, either domestic or external debt, under the current liabilities. You have to be careful because if there is domestic debt under current liabilities or external debt under current liability, then that is also an interest-bearing debt and hence should form part of the long-term debt or the debt of the country. So that is something you have to be mindful of going into the exam, that sometimes there could be a debt under current liability, which is an interest-bearing debt. The payables here, not an interest-bearing debt. Deposits and trust monies, not an interest-bearing debt. So in the context of this question, we're just going to stay within the ambit of these we have here. 74,400, 123,500. One, two, three, 500. So we can divide that by the total assets of the entity. Total assets, as we used a moment ago, 238,800. And then 295,450. Okay, so what do we have? 74,400, 238,800. I'm getting 0.31. Okay, or 31.2%. Because we could multiply that by 100 and express our answers in percentages. Then for the other company, other country, we're not in private sector, 0.63. And so that could be about 63% in that case. So if you check from this perspective, the debt as a percentage of the total asset, if you look at it, is 63%. For Obi Manso, for Boga, it is just 31% in that case. It's also measuring like how the entity is financing its activities. That is why we are measuring the gearing. Because remember, in the private sector, gearing ratio would typically measure the financial risks of the entity, the ability of the entity to raise additional debt finance in the future. Right? That is what we're going to be looking at. The same idea is going up here. So we are looking at the ratio of the debt to the total assets of the entity. Was a percentage. And really we could say that Obi Manso is, slightly geared, about 63%, and Boga is just 31.2%. But that is one way this ratio could be calculated. Alternatively, as I mentioned, we could use net asset for the calculation. Okay? Net asset for the calculation. And you know that net asset is total asset minus total liabilities. Okay? So net asset equals total asset minus total liabilities. And so if we are doing this for the two countries, so Boga and Obi Manso, we bring in the total assets, then we less the total liabilities. All right? So let's see what we have here. So total assets, 238,800. For Obi Manso, 295,450. Then the total liability side of things, if we check here, it is going to be the current liability plus the non-current. So when you add this and this, it gives you this figure. So 169,200 as against 221,350. So we are subtracting, okay, to get a net asset. That is another way we can get the owner's fund. So 238,800 minus 169,200. That is 69,200 here. 295,450 minus 221,350. And that is 74,100. Right? 74,100. So now we could pick these respectively and go and put them here. Still going to be the interest-bearing debt, like this. And then we get the answers coming up. And so this time around, if we use the net asset, we get around 1.10. That is above 100%. Okay. That's around 1.075. So times 100, like 107%, 107.5%. So the debt is more than the net asset of the entity, or 123,500 divided by 74,100. And that is like 1667. So either way, you realize that the ratio is still higher for Obi Manso at the end of the day. Because it's like, again, in the private sector, in the FR class, if you want to measure the gearing level, you could use the traditional formula, which is debt over equity, right? Or you could use debt divided by capital employed. Does that make sense? To calculate the gearing ratio. But then in the public sector, as I said, we don't have equity. In the public sector, we don't have equity. This is public sector accounting. So since there is no equity in public sector, because I'm seeing a question coming up here, that is why I'm addressing that. Say, why not equity but total asset? This is public sector. There is no equity in public sector financial statement preparation. So you cannot deal with equity here. What we have here is accumulated fund. And that is why we can't use equity, but we either use total asset or the net asset for the workings. So that is the reason for that. The fourth one, accumulated fund to total asset. Accumulated fund to total asset. Now, accumulated fund to total asset is like the reversal of what we just calculated. I need you to stay with me carefully because you see, interpretation of the ratios is easy if you get the spirit of the calculation you are doing. So if you look at the calculation we just did, we did debt over the total asset, which means what is the percentage of the total assets that represents debt? Now we are going into accumulated fund. Accumulated fund is like the equity in public sector, right? So with accumulated fund to total asset, what we want to look at is what is the contribution of the country's own fund in the total asset of the country. You get a picture, right? So the debt to the total asset, we are looking at, okay, of the total asset, how much is financed through debt? Now, accumulated fund to total asset, we are looking at, okay, of the total asset, how many percentage is the contribution that the countries did themselves? I hope that is clearer. So, because you have to understand the calculation, then boom, the interpretation will come naturally. So, accumulated fund, that will be IV, accumulated fund to total assets. Now, so this is the trick. We expect debt to total assets to be lower and accumulated fund to total assets to be higher. Why? Because if accumulated fund to total asset is higher, it tells you that, a lot of the assets of the country or a lot of the assets of the covered entity are financed by the country or by the entity. But if the debt to the total asset is greater, that means a lot of the assets are financed through debt, which increases the debt sustainability of the country, which may also affect probably the debt to GDP ratio of the country. Then, so the formula is going to be just accumulated fund divided by total assets. Okay? Accumulated fund divided by total assets, certainly times 100 because we are just looking at the percentage that it is going. So let me just duplicate this. So you see, I am writing the formulas down, right? Because that is all part of the workflow. Got to write the formulas down. Okay? But I'm just trying to present in a different way where I have my formulas on one side and then I have my solutions on another side. That doesn't mean you have to present this way, but I just want to keep things a little bit simpler for me. So that's how I'm dancing the way I'm dancing. So accumulated fund respectively is 69,600, 74,100. So 69,600, 74,100. We divide that by the total asset, which I think we used a moment ago. Here. Boom. So we punch this out respectively. And that is like 0.29 or 29%. Okay. Or 29%. Then 74,100, 295, 450. And that is 25% or 0.25. So what do you see here? You see that country bugger has financed themselves about 29% of their total assets, right? But country Obimanso has done just 25%. So if you check the flip side, because they own less than about 25% of the total asset, that is why they have more of the total asset financed through debt. I hope you are getting the relationship here. That's the connection. So debt to the total asset. What is a percentage of the total asset that is financed through debt? Accumulated fund to the total asset. What is the percentage of the total asset financed by the entity? So whilst we want this ratio to be up, that is what the state is funding to be up, we expect the debt to the total asset should be reducing or should be lower. The reason is because although debt is good, you don't want to have a lot of debt hanging on your neck. Because when that happens, it means if there is a critical issue and you want to raise additional debt finance, then the market is going to be closed to you. And then in that case, even if people are willing to give you some money, they will give you the money at a higher interest rate, which means your debt may become unsustainable, which means your debt to GDP ratio may be higher, which means you may have to restructure your debt like we suffered under the previous administration. So that is the impulse of what is happening here. Do you get the idea? That is why it is good that the country finances and owns a lot of the assets rather than borrowing money to finance them, because it puts a lot of pressure on you. You need to tax the citizens to be able to repay the debt. Your gearing or the debt to GDP may be rising significantly and you may suffer. But it is not bad also. And that is the beauty about debt. The fact that the debt to GDP ratio of a country is above 60%, which is the threshold, does not mean the country is having a problem. Because America has debt to GDP ratio at some point over 100%. Debt is not a problem. If you are borrowing and you are putting it into productive use and it is generating GDP, then it may not be a problem. But if you borrow the money for recurrent expenditures like payment of wages and salaries and those other things, then it wouldn't be good in that regard. So that is a relationship between these two ratios that you are seeing here. Then the last one is common size analysis of tax revenue, compensation of employees, and then sales surplus. So it's like in this question, the examiner is doing some interesting things. So common size analysis, it simply means what is the percentage of total revenue used to finance employees, compensation of employees? What's the percentage of tax revenue that represents surplus at the end of the day? And so that's the last one, the common size analysis. So common size analysis. So first, we will do tax revenue. It means what is the percentage of tax revenue coming in from the total revenue? Sorry, how much of the total revenue comes from tax revenue? So we'll do tax revenue divided by total revenue. And that is going to be 302,400 for Boga, 317,300 for Obi Manso, and the total revenue 363,240 as against 399,885 times 100. So let's see, 302,400, 363,240, 83%. So 83% of the total revenue of Boga came from tax revenue. Not surprising, right? Because for developing countries most of the time, and almost, even developed countries, majority of their revenue will come from tax sources. So it's not surprising at all for us here. 399,285. And they are doing like 79%. All right, so they are all high in that regard. So when it comes to tax revenue, there's a significant portion of their total revenue coming from tax sources, which is not surprising because they are all developing countries, and the only way they can survive is taxes at the end of the day, because they will carry out a lot of social issues and hence, will not have significant non-tax revenues coming in. The next one is compensation of employees. What is the percentage of total revenue that was used to pay wages and salaries? That is the compensation of employees analysis. And as much as possible, we want this ratio to be lower, because you don't want to use a lot of your total revenue to pay wages and salaries or to compensate your employees. If that happens, then you cannot get the necessary resources for the government machinery, goods and services. You cannot do social benefits, providing assistance to the less privileged in the society. You cannot give subsidies out to your citizens. And so cost of production and cost of consumption is going to be expensive. So we don't want governments to be spending significant percentage of its total revenue on compensation of employees. Let's see what we got here. Compensation of employees, we have 190,512 for Boga, and then the other one is 161,880. So we divide that respectively by this. So what is the percentage of total revenue used for each of these ratios? Let's see. 190,512 divided by 363,240 times 100. 52%. Okay, 52.4% of their total revenue is going, more than half is going to pay wages and salaries. That is not good at all. But we have to also understand where the countries are, right? They are developing countries, and for most developing countries, the government is the highest employer. Okay? It doesn't happen in all countries. Okay? In other countries, the government is not the highest employer because the government has empowered the private sector, so the private sector has more employment on the average than the government in some other jurisdictions. But for developing countries, the They may have a lot of people employed by the government, going through the government payroll. And then also there could be a lot of corruption, ghost names in the payroll. Recently, you heard about the story that came out about the auditor's report where University of Ghana, they were having problem. Some issues came up allegedly about overstatement of compensation of employees, in the university. And I think a media house published it. Is it Joy News or so, multimedia? And then the teachers of the institution also had a press conference to sort of discount it and sort of also say something negative about the media house. But the media house was only publishing what has been published by the Auditor General. That you guys are cooking. So why attack the media house? Why not go respond to the Auditor General? Do you get the idea? So that's the concept here, because we don't want a lot. So yes, they are using 52% of their revenue to finance compensation of wages and salary. Why? We may have a reason for that in a moment. Then the final thing is surplus. So we want to find out of the total revenue that they generated, how much was left after the expenditures they undertook during the year. So normally, it's in between the two. On one side, you would want the government to have some surplus. But on another side, if the surplus is too much significant, it means government is not spending. Now, that could be part of a fiscal policy of the government to decide not to spend because maybe there is a lot of inflation or the inflation rate is very high. So government can reduce spending, okay, so that the economy is balanced. And so sometimes when the net operating results is negative, maybe it's because the country, there's low economic growth. And since the government is the highest spender, again, in most developing economies, they would have to spend money. So it could be part of a fiscal policy that the government is pursuing. And so there is two-sided coin here. On one side, it could be good based on the economy we are in. On another side, it could be bad because if government has a lot of surplus and it's not spending, it means they may not be giving out subsidies. It means social benefits may be lower. So the less privileged people in the society or in the community may not be having the necessary support, which will then reduce the standard of living of the citizens. So it's a ratio that must be interpreted from a certain perspective because either side can be right based on the way you explain it. But let's look at the surplus we have here. They are all having surplus, 336,000 here. So that could be around 10%-ish. And then 71, 250-ish. So let's see what we got here. 36,000, 363, 240. So 9.9, maybe 10% approximately if we can run it up. So 10% of their revenue was left as a surplus. Is that a good thing? Is that a bad thing? Again, it depends on where we are standing to do the interpretation, as I discussed with you a moment ago. And that is about 18% approximately. So 18% of the revenue that the government generated by the revenue generated by Obi Manso was left at the end of the period. They didn't spend it generally. Again, is that good? Is that bad? As I said, it depends on where we are standing. It depends because it could be part of a fiscal policy strategy. Because usually it would have been a negative, which means the government is spending more at the end of the day because it's necessary. And that is where the budget has to be, the deficit should be financed. But if it is surplus, it means the government is not spending more. Does it mean it is bad? There are indicators of it in that particular case. So these are the ratios that we can calculate in the context of this question for the first slide there for us. And then the accumulated fund to total assets. Then the calculations of the ratios. And then the last part with the common size analysis. So this is the first part of the play. In this question, technically, the calculation wasn't a rocket science. But there are some ratio questions. Once you miss one calculation, it's going to screw you up in the entire calculation.